In today's video, I am going to be talking about dividends and basically the beginner tips behind them, because basically it's maybe not always so simple to see and understand what these are actually doing for us. So first off, what is a dividend? A dividend is when a company makes money and makes enough money to be able to pay their investors. Okay, so let's say this is a bank, for example, TD Bank. And from there, TD Bank, let's say, makes $1 million, and that's a lot of money. But let's say they actually made 50% profit. Let's make math easy, and say they made 50% of that as profit, and they made $500,000 profit. Well, out of that $500,000, now obviously TD Bank makes a heck of a lot more money than $500,000 profit, but this is just an example. And let's say they had 4 investors. Well, TD Bank obviously needs to keep some money for themselves out of that $500,000. So let's say they want to have a 50% payout ratio, which means that they pay out 50% of their profit, which is basically a quarter, technically speaking, of that $1 million. Now, from there, if they only have 4 investors, let's make math even easier and say they have 5 investors. And from there, what would we see? Well, that would be a $250,000 payout out to their investors. Well, that would mean that each investor would get $50K each. Well, that obviously sounds very simple and easily explainable, but how come not everyone is making $50,000 from TD stock? Well, first off, they obviously make more than that kind of money, but from there, they have millions of investors. They have millions of shares. This is just an example. This is not saying that TD makes only $500,000. They're making billions of dollars. But when it comes down to it, they pay out about 3.5% right now. Depends on where the stock is of the day and if they increase their dividend or not. But either way, they're paying currently 3.5% of their dividend, which means, let's say you invested $100 into their stock. At 3.5%, you would then make every single year as cash 3.5%, which is about $3.50. Now, that may not seem like a ton of money, and it's not, because it's only $3.50. However, if you were to invest, let's say, $100,000, then at that point in time, you would actually be making about $3,500, and obviously this is fantastic. Now, that still doesn't seem like a ton of money versus how much you invested. However, we have to remember that an average bank stock in Canada will go up roughly between 3 and about 8% a year, and that's on your underlying value. From there, they also usually increase their dividend, we'll say increases, by usually between 2 and about 9% a year, depending on how good their income was, and of course, what their board of directors and everyone else thinks of the increase. So, from my experience, it's usually around 5% increase every single year. So for example, if you were getting paid this year $3,500 and you wanted to, or you've seen that it was going to increase next year by 5%, you would actually get a raise of about $175, which then means that you will be getting paid about $3675 a year next year. And if that continues to grow, it actually, on average, throughout the entire banks, around every 6 to 7 years, on average, a Canadian bank actually has their dividend essentially doubled because of these pay raises. Now, of course, that's not going to happen right now because they haven't been allowed to raise their dividend for about 1.5 years because of COVID, but they've been still paying the exact same. This is actually a great kind of backup if you were to lose your job and, let's say, because of a pandemic like we're currently apparently in, then at that point, then we would be able to still at least have some cash coming in to pay at least some of our bills. Now, TD Bank is a great example. They pay a 3.5% dividend right now, roughly, and from there, they're going to probably increase it next year. They've been recently allowed to raise their dividends. So because of that, what we can see is that there's going to be an increase on their dividend. But what about these other stocks? Let's say, for example, Enbridge that pays 6.5%, or some ETFs that pay close to 10%. What about them? Are they safe? Well, generally speaking, what you will have is if a single stock is a very high dividend, for example, an Enbridge that's 6.5%, or let's say a Laurentian Bank a couple of years ago that was upwards of like 7%. Are they safe? Well, Laurentian Bank actually lowered their dividend. Meanwhile, Enbridge hasn't. They've actually increased it. And why is that? Well, Enbridge is making tons of money and they can pay it, while Laurentian couldn't. How are we able to figure this out, though? How are we able to figure out when a company is going to be able to pay their dividend? Well, it actually comes down to that first equation that I showed you. That equation where it was that payout ratio. Generally speaking, if they're paying out more than 50% of their earnings, at that point in time, it's a more riskier dividend play. However, if they're lower than 50%, and these are my own numbers, what I go by, everyone's numbers are different, but if they're paying out lower than 50%, then it's a more riskier investment. Their stock price might still go up, but their dividend percentage might actually go down because they may have to lower their dividend because they're making less money. So that is kind of the playoff that you need to really watch for. There's also dividend ETFs that are quite interesting. Let me show you. So for example, ZWK is a BMO covered call US bank ETF. Basically, it holds US banks. However, it runs covered call options against those bank stocks. So even if you don't know what a covered call is, that's totally fine. I'll kind of give you a brief overview. However, what you're getting here is not just pure earnings dividends. You're actually making an income, a yield from those covered calls that are being sold against those stocks that you own. That's why the yield on this ETF is currently 6%. Now, what you will find in some of these covered call ETFs is the huge MER, which is how much that ETF charges you to invest your money, so keep that in mind too. However, a brief overview is, let's say you have a stock of Facebook, just because it's easier to write FB. Let's say you have a Facebook stock, but let's say you have 100 of them, and you want to basically have an income from that stock that doesn't actually pay a dividend right now, but you want to make money from it. Well, guess what? You can sell an option for somebody to buy those 100 shares, and we'll stick a person over here who's happy and wants that stock. And from there, what we can see is, well, we can sell an option to buy those 100 shares, and let's say Facebook's currently at $300, just fake numbers. Let's say it's currently at $300. And you want to make an income off of that $30,000 that you currently have invested and don't want to wait for Facebook's stock price to go up. Well, you can actually sell an option for this person over here to buy those 100 shares. And that person will pay you a premium, let's say, of about $200, or let's say $300 because I wrote $300 by accident. Let's say he'll pay you $300 for the option to buy those 100 shares, but in about 6 months. And he will only be able to buy those shares at $300 in 6 months if those shares in 6 months reach, let's say, $450 a share. Now, in 6 months, if the stock goes to $450, this person will buy the shares for $300 a share, and you'll basically lose your shares at $300 each. However, you get to keep his premium. So you made $300 still in that trade, but you lost on that upside of $150 a share. On the flip side, if Facebook stock did not go to $450, let's say it went to, just to make this person really sad and upset, let's say it went to $449.99. Well, guess what? This person is now very, very, very sad because he doesn't have the option now to buy those shares. He lost his $300. He basically lost the bet. That is how you can make extra premium on your shares. You can make more money on your shares. It's a riskier option. However, you can make a lot of money from that riskier option. And as an individual, we can do this. However, again, it just basically comes down to the fact of it takes a lot of work, it takes a lot of effort, and it's not easy. Meanwhile, we can invest into an ETF that already does that, and we'll already know where the price may or may not go in the future and kind of try to sell options against that to know, hey, it's not going to reach that price anyways, so it doesn't matter kind of thing. Let somebody else, let a professional do it, because we're not spending probably 10 hours a day looking at a computer saying, I wonder where that stock price is going to go. So this is a covered call strategy that you could run or you can invest into that can make you a lot of yield, a lot of dividends. So this is kind of a brief and kind of technical beginner's guide to dividends. I hope that it's helped you and probably confused you a lot, but either way, I tried. And if it has helped you, hit the like button, subscribe, leave a comment down below, and I'll see you guys again next time.